3, 2, 1. Welcome to the show.
All right. This is like take 3.
Yeah, we had a little bit of technical difficulties.
Technical difficulties this morning.
But we're back. You guys don't know that, but we know that.
Man, what a week. All right, let's get into it because I have a lot of stuff to do on here.
All right. I like it when we got a lot of stuff to do.
TSP Weekly Podcast for February 2024. So we'll take a look at some of the enormous amount of stuff that happened this week on the market. It'll be the last time we talk about the January barometer. You know, that if you guys remember, that included Santa Claus rally, which was the last 5 trading days of the year, and then the first 2 trading days of this year. And then the first 5 trading days of January is the second piece. And the third piece of the barometer is how January finishes. So we'll take a look at that. Risk-off ratios, something I put out on Facebook and Twitter this morning, actually. It's kind of interesting that while the market is still moving higher, it's being led, at least yesterday, which yesterday's big rally after Wednesday's kind of collapse from the Fed meeting. Yesterday's rally was led by consumer staples, which you would expect it would be led by tech. And so that's either some kind of sector rotation or it's the beginning of the market rolling over. And we'll take a look at that. And then it's the end of the month, so we get to do monthly candles. We don't do this very often. I'm going to put it in my calendar to do it at the beginning of every month, because monthly candles are really important. It tells you the kind of longer trend, which can keep you from getting whipsawed in and out of the market. And then we'll take a look at the TSP CAF Fund chart. Okay, so what's going on in the market this week? Actually, kind of starting from last week, the Magnificent Seven loses a player. Tesla is way off. I got it in here. Tesla was off.
I've been hearing people refer to it as 6 plus 1 now.
6 plus 1. What's the plus 1?
Tesla.
Tesla's
they
plus
take
1.
it out and say
call it the plus 1.
Doesn't get to be in there with the other 6.
No, it's down 25% since the beginning of the year, and it's continuing down even to today. So yeah, Tesla's got some serious problems. We had big tech earnings all week this week. I don't know if any come out today, being Friday, but definitely some came out last night with some really big results. Meta was kind of volatile for the week, but when I redid this chart first thing this morning, it was up 17%. As of when we're recording here, it's up 19.5%. It's not every day, if ever, that you get a $1 trillion company that gaps up 20% in a day. It's unbelievable. And I kind of thought Facebook was on the decline. I mean, I can't stand being on Facebook. Facebook, Instagram, and TikTok, I think, Facebook, Instagram, LinkedIn is in there. But yeah, Facebook and Instagram are definitely the 2 drivers in social media. We had a big Fed decision on Wednesday. Everything was fine. Rates held steady. Everybody expected that. But then at the press conference, I can't remember what the question was asked, but the answer that the chairman gave was, it's very unlikely that we will get enough information by the March meeting to make us think that inflation is under control enough to start lowering rates. And that's when the market tanked, because everybody was betting that the Fed was going to start lowering rates in March, and they pretty much came out and said, nope, we're not doing it in March. He said we are done with the tightening cycle, but and we are going to lower rates this year, but it's probably not going to be in March, and the market did not like that. And then Friday, this morning, we had the jobs report. We got 353,000 new jobs created versus 185,000 forecast. So earlier this morning, futures were way up, and then they came back down because if you have more jobs being created, well, it's a good thing for the economy, you would think. It's a bad thing because it's inflationary, and it even goes more to the Fed not lowering rates in March or maybe even May. So we'll continue to see how that goes. And the unemployment rate stayed the same at 3.7%. And CPI is the big inflation indicator that the Fed looks at. That came out this week. It was up to 3.4% versus the 3.2% forecast. And what's really interesting about CPI, I got this chart off of investing.com right here. This is going back to 2017, so it's the level of CPI. And right now, it's 3.4, right? But what's important to look at on this chart, we were up above 9% at the high in 2022 was the inflation rate, right? And it came down in a hurry, right? Fed kept raising rates, inflation rate comes down, everything's good. The Fed's target is 2%. And they've been talking about how they're calling it the last mile. It's going to be really hard to get from this 3.5% level down to that 2% level. And you can see the question is this month the beginning of a new move higher, right, in inflation? Because the Fed needs inflation to come down to that 2% level. And so this is not good. That bar took out the last 2 months of declines. And so the longer, this is what they call sticky inflation, if you hear that term, that they're really trying to force the rate down, and if they can't do it, it's unlikely that rates are going to come down anytime soon, based on CPI, and that's the primary inflation indicator that the Fed looks at. And then with the jobs report, it definitely pushes this higher. So Fed's got a tough job. Okay. January barometer. So the January finished the month, S&P 500 up 1.59%. Okay, so the January barometer was positive, right? So I got this. If you go to stocktradersalmanac.com, or if you go to Twitter, it's Almanac Trader on Twitter. That's Jeff Hirsch. He's running Stock Traders Almanac. And what he put out was, as the S&P 500 goes in January, so goes the year, 74.4% of the time. So basically 75% of the time since 1938, if January is an up year, then the full year is an up year. Okay. The next 11 months follows 67.4% of the time. So basically February through the end of the year tracks January 67% of the time. So the odds are over, since 1938, the odds are that 2024 is going to be a positive year because January was positive. Okay. So the barometer was developed by Jeff's dad, actually, Yale Hirsch in 1972. We had what he's talking about here with a negative Santa Claus rally, which we had this year. The first 5 trading days of January were down, which we had this year. JB, as the January barometer, holds the key, right? When January is up, after Santa Claus rally and first 5 trading days are down, S&P 500 advanced 3 times over the remaining 11 months and the full year with averages of 15.1 and 19 or 20% respectively. So what he's talking about there is we only have three times going back to 1938 when we had a negative Santa Claus rally, a negative first 5 trading days, but a positive January. It's only happened 3 times. So it's statistically, they try to say it's statistically significant. I don't see how 3 times can be statistically significant, but that's where he says the full year is up 19.9% and the last 11 months are up 15%. So that's where that comes from as far as the stats go. And the kind of the idea of it is that it started with the 20th lame duck amendment to the Constitution in 1934. Basically, senators and reps took office the first week of January. New presidents inaugurated on January 20th. But before that, members of Congress were not seated until December of the new year, and presidents were not inaugurated until March 4th. So the changing of those dates generated how money comes into the system. And that, they think, is the reason for why the January barometer is statistically significant at this point. So beginning the first month of the year, it's the time when people readjust their portfolios, try to make a fresh start. financial analysts rethink their outlook for the coming year. There's also an increase in cash flows into the market in January, making market direction even more important. Then there's the all the information to digest, the federal budgets, national goals, priorities, all the FOMC meetings, and all the other economic data. So that's the idea of the January barometer. Again, I would say that the trifecta, when the Santa Claus rally is negative, first 5 trading days are negative, and the January barometer is positive, it's only happened 3 times. And the 2024, if it's it will be the 4th time that has occurred, and we'll see if what happens in the last 11 months and the full year. All the other times, this is what you're kind of looking at. That's when the January barometer was negative. Okay, that's when everything was down. Even at then, you still have some positive years. But again, it's statistics, and it doesn't mean that that's what's going to happen this year. But that is pretty much it for the January barometer. So it's bullish, right? From the January barometer perspective, it's bullish. This is another kind of way to sort the same data. Ryan Dietrich, really good guy to follow on Twitter, noted at the end of December that when the S&P 500 gained more than 10% in the last 2 months of the year, so November and December, I think we were up 14% in November, December of 2023. So when you're greater than 10% of the last 2 months of the year, January, first quarter, and the full year next year tended to be really strong. So like you're saying, we're off to a good start. These are all the times when November and December of the prior year were greater than 10%, and we had really big gains by the end of the year. And the question mark is what happens in 2024. So kind of a little bit different way to sort the data. It's more statistics, but the odds are, based on history, that we have a good year in 2024. Okay, so that's kind of the crystal ball version. Both of those are kind of crystal ball-ish. On the other hand, you got JC Peretz at allstarcharts.com. Definitely you want to follow him on Twitter. If you follow him over time, he was one of the guys that was right on in 2023. He had been calling for the bull market to begin actually at the June 2022 low. And then the October low, price was a little bit lower than it was in June 2022, but he saw that as basically a retest. So he was bullish all of 23, did really well. Going into 24, now he is actually actively shorting stocks, which I find kind of amazing. We're talking about it on the newsletter this weekend, exactly what JC is putting out, and Tom Lee, who is, they call him the perma bull on Wall Street. If you go to his Twitter page, he's got a pinned video that the last 2 interviews he did on CNBC, he was expecting a new all-time high in January, which obviously we got, and then he says then there's an air gap that needs to happen, and he's talking about a 5 to 7% drop here relatively soon. So 2 guys that were right on target in 2023 are pretty bearish right now through like the middle to end of March. And they come to it from different directions. So this chart is from JC Peretz. So what this is, IEI is basically cash. Okay, it's U.S. Treasuries versus high yield bonds. So this is a Treasury bond fund, and this is a high yield growth bond fund. So it's basically risk off. If you are in a Treasuries, which is essentially cash, you are risk off. If you are in high yield bonds, they're riskier bond funds, and that's risk on. So the ratio here is risk off to risk on. So when the line is going down, cash is decreasing relative to risk, right? So as the line is going down, people are buying riskier things. So we had a support level here. Okay, we dipped below it, but as long as the ratio is above the support level, the line is going up. It means investors are going more into cash and less into risk. Okay? So even as the price of the S&P 500 is going higher, investors are moving to less risky things, right? More treasuries, less high yield growth. The next one is similar. XLP is consumer staples versus the overall S&P 500. So consumer staples are things that you need versus things that you want. And so since we know that the S&P 500 is being driven by the Magnificent Seven, which clearly nobody needs a Tesla, everybody wants one. The Tesla's kind of a bad example right now because they kind of tanked, but Meta and all the rest of them, they're not needs, they're wants. But as long as the line is above that, 147 or 1478 there, investors are more into consumer staples and less into the S&P 500 overall. So it's another risk-off ratio, and these are the two big ratios that JC is looking at to tell them that it's time to actively short stocks. Okay, that's like the kind of the technical analysis piece. This one is showing, we've put this chart up before, but this is kind of an update to it, right? This is the election cycle. What happens in the S&P 500 during the election cycle, that's the blue line. The red line is what's actually happening in the S&P 500 in 2024. So history tells us to expect a pullback, and again, trend is more important than level. So it doesn't mean it's going to pull back some big number. It just means that a pullback is likely from the top here at the beginning of February to about the middle of March. And so this chart was updated a couple days ago, and that big decline right there, was Wednesday when stocks tanked. And obviously since then it's come back up. So, but this is the risk, right? This is a big risk section in here. It's why Tom Lee thinks we're going to have an air gap to fill and we're down 5 to 7%. It's why JC is actively shorting stocks, but everybody agrees that's a short-term position to take because pretty much everybody expects 2024 in the big scheme of things to be a positive year. So high possibility for some short-term volatility and potentially a pretty decent correction going into March, and then that should be the bottom for the year. We will see. All right, monthly candle charts. So this is a chart of the S&P 500. So each tick is 1 month of price movement. Okay. So in the first chart, what I did was just to show, this is a logarithmic chart. So the distance, the good thing about logarithmic charts is the distance is what you're looking at. So we know that the top in 2007 to the bottom in 2009 was a 55% decline in the S&P 500. And so I took this line and brought it over here. So if we had a decline similar to the great financial crisis, this is where we would be. Roughly, we would go down to about the COVID bottom. So just for some perspective, if kind of a worst case scenario, if the market completely tanked and we had a 55% decline, that's what it would look like. Okay. So kind of the more valuable tool for the monthly candles is if you can see a long-term trend here, right? So all I did was connect the major lows. We had an overshoot in COVID, but this long-term trend is clearly still in place. Okay, so until that trend changes, we're not worried about any big decline to get down here to the COVID low, something like this, because you have to have a break in that trend first. Okay, so if you're watching the show, if you're a subscriber to the site, we don't make reallocation decisions based on monthly candle charts, but if we ever got down here below that trend line now, so say 3,900, that's a giant red flag because barring COVID, we haven't been below that trend line, since back here in 2009. And then if you drill it in a little bit closer and you connect the bottom from the October 2022 low, we have this point here we touched, and this point here was in October of 23. So now we have this trend line that's shorter, but still pretty long, right? It's going back to the middle of 2022. So any close down here below, certainly below this low on a monthly basis would be something to be concerned about. But right now, we are still challenging, on a monthly basis, challenging that previous high. And we're above it, and we should expect the market to keep going higher. So it just gives a much bigger perspective. S Fund, I did the same kind of thing. This was the decline in the S Fund from 2007 to 2009, and it would look something like this, kind of similar. We would get back to the lows of COVID on the S Fund. Disregard this; it's kind of an anomaly in the trading view chart, as I didn't draw that. Interesting thing to point out about the S Fund, it is still nowhere near the prior high from 2021. So the hope is that, the S Fund is the 4,500 smaller stocks in the U.S. versus the S&P 500, which is the top 500. So if this rally is really going to broaden out, the S Fund needs to start picking up and start moving forward. But we're not there yet. But that's where we are in the S Fund. So, you could draw the same kind of trend line. None of this is exact. You're just trying to hit the major bottoms, and they tend to form a line. We got to overshoot again in COVID. This was a little bit of an overshoot, and so we're closer to that trend line on the downside than we are in the S&P 500. iFund. Interesting thing to point out about the iFund, it still has not gotten back above its all-time high in 2007. It's got a pretty good channel, so you can draw this channel in the iFund and pretty much trade it. I mean, you're selling it when it hits that top, and you're buying it when it hits the bottom trend line, and that would have worked over the years really, really well. Right? Didn't get up there this time. We had the overshoot from COVID, but then it continues right along. And so certainly the iFund, we would expect it to get back up to that upper channel line before it starts rolling over again. At least that's what the history of the chart would tell you. F Fund. I didn't go all the way to the beginning, but the AGG actually started back here in 2004. And so anybody that had invested in the F Fund back here at the very beginning of it in 2004 is still negative. You're still below where you started. It's this decline in the F Fund has been absolutely unbelievable. It's also a really good way to see the Elliott wave count. So you got 1, 2, 3, 4, 5. So this should be, I think it's pretty well established bottom at this point. The question is, if this is a 1, 2, 3, 4, 5, it should be a 1. So we get an A, B, C correction, and then the next move down in bonds. So in terms of the F Fund, this is what we're looking at right now. We talk about it quite a bit on the newsletters. With yield flying around as it is, it'll be interesting to see if the price of the F Fund moves higher and then comes down and then moves higher. That's what should happen. So we will see, but it gives you a pretty good understanding of the magnitude of that collapse in bonds from the top in 2020 rather. It's pretty unbelievable. All right, so where are we today? C-Fund chart on a weekly basis. If you guys remember last week, we did this 1.618 extension, and we did a whole bunch of examples of the 1618 over, I think, going back to 2008. You could definitely go back and look at last week's podcast because it was pretty good. We did a pretty deep dive into this. And this is where we said we were as of last week, and we're approaching that 1.618 extension from the top in August of last year to the October bottom. So we did the extension 1618 using the Fibonacci extension tool, and we were just below it, right? And we're saying we would expect some resistance. So at the 1.272 level, we got a whole bunch of churning in the market until it finally broke higher. And now it's approaching that 1618 level. And so what happened since last week? We got to that 1618 level, and we are, right now, we definitely have resistance there. So it doesn't mean we don't get resistance, we go sideways for a little bit, and then go higher, right? But as you can see, we are definitely hitting resistance at that level. It would be pretty consistent if we did something like this going into March, right? And then started moving higher. That would be consistent with the year for the election cycle, right? Again, that's like forecasting, and it's valuable to do that. But at the end of the day, you got to respond to what the market actually does. So, the weekly chart. So each one of these ticks is a week of price action. What I would be really looking at if I'm looking at the C Fund on a weekly basis, this was the all-time high in January 2022. So as long as we stay, so I connected the top to the top of this churning, that consolidation period right there. So as long, that's where we really want to stay above. We want to stay above 4,800. A close below 4,700, basically below this low, would be the final line in the sand for me if I was following this on a weekly basis. Because if we get, if we were to come down here, come back up, come back down, now you're looking at a really good head and shoulders pattern, right? So this 4,700 level would be pretty critical if let's say the market does roll over going into March and does something like this, you'd need that other shoulder. But anyway, 4,700. So this is the range. We want to stay above this level. We definitely don't want to get below that level. All right. That is all I got. I went through that much faster than I thought I was going to go through it.
That usually happens when you say, "Oh, I got a lot," and it's
There's
it's
so much. I mean, sometimes it takes
plenty.
Sometimes it takes a lot. All the time, it takes a lot to put this together. But sometimes there's so much information that to whittle it down to things that are relevant and
if most people knew how long it takes you to sit down and kind of put all that together, they might appreciate the show a little more. So I'm telling everybody, Jerry didn't whip that together in about 30 minutes. It takes pretty much a lot of the week.
Takes a minute.
But we love you for it. Questions. If you have questions, as always, you can put them in the comment section wherever you find this video. If there is no comment section, shoot us an email at support@growmytsp.com. The support team will send that over to us. And, if we can answer it, we will. A lot of times we use those questions in the show because if you're asking a question, there's probably, a couple thousand other people that have the same question.
Yep. Questions definitely help jiggle me to answer things that are relevant to what people want to hear.
Yeah, for sure. All right, guys, hope you enjoyed the show. If you did, please share it with your friends. If you didn't, share it anyway. And we will see you.
Have a good weekend.
Next time. Cue music.
Don't